Cayman Islands investment funds and hedge funds explained. The Cayman Islands is the world's leading domicile for hedge funds and alternative investment vehicles. Its combination of regulatory pragmatism, tax neutrality, legal certainty, and deep service provider infrastructure makes it the jurisdiction of choice for managers launching funds that accept institutional and sophisticated investor capital. This guide explains the principal fund structures available, their key features, the formation process, the role of the Cayman Islands Monetary Authority, CIMA, and how Cayman compares with competing jurisdictions. What are Cayman Islands investment funds? A Cayman Islands investment fund is a collective investment scheme organized under Cayman law to pool capital from investors and deploy it in accordance with a defined investment strategy. The legislative framework draws primarily on the Mutual Funds Act, as revised, and the Private Funds Act, as revised, which together regulate the two broad categories of fund. 1. Mutual funds, open-ended vehicles that issue redeemable interests and are regulated under the Mutual Funds Act. 2. Private funds, closed-ended vehicles that issue non-redeemable interests and are regulated under the Private Funds Act. Common legal structures include the exempted limited partnership, the dominant private fund vehicle, the exempted company, the segregated portfolio company, SPC, and the unit trust. The choice of structure depends on factors such as investor base, strategy, and liability ring-fencing requirements. Key features of Cayman Islands funds. Cayman hedge funds share a set of characteristics that have driven the jurisdiction's dominance. Tax neutrality. No income tax, capital gains tax, withholding tax, or corporate tax is levied at the fund level, ensuring a single layer of taxation at the investor's home jurisdiction. Flexible investment mandates. Funds may invest across asset classes, including equities, credit, digital assets, derivatives, and real assets, with no statutory restrictions on strategy. Investor familiarity. Institutional allocators, pension funds, endowments, and sovereign wealth funds routinely accept Cayman fund documentation as market standard. Deep service provider ecosystem. A mature network of administrators, custodians, auditors, prime brokers, directors, and legal counsel supports the full fund lifecycle. Robust legal framework. English common law underpins the Cayman legal system, providing predictable contract enforcement, experienced courts, and a well-developed body of fund-related case law. Benefits of investing in Cayman Islands funds. The jurisdiction delivers a combination of commercial and structural advantages that benefit both managers and investors. Speed to market. A standard Cayman fund can be launched in 2 to 3 months, where documentation is in agreed form and service providers are engaged. No exchange controls. Capital moves freely into and out of the jurisdiction without restriction, supporting global multi-currency strategies. Regulatory proportionality. CIA applies risk-based supervision tailored to fund type and investor sophistication, avoiding the prescriptive operational requirements seen in onshore regimes. Global recognition. Cayman fund vehicles are widely accepted by US, European, and Asian counterparties and satisfy the due diligence requirements of major institutional gatekeepers. Liability segregation options. SPCs allow managers to ring-fence assets and liabilities of individual strategies within a single legal entity, reducing cost and complexity for multi-strategy platforms. How to set up a fund in the Cayman Islands. The formation process is well established and follows a predictable sequence. Structuring and strategy definition. The manager works with Cayman Council to select the appropriate vehicle, exempted limited partnership, exempted company, or SPC, agree on governance arrangements, and confirm the regulatory classification, mutual fund, or private fund. Service provider engagement. The fund appoints an administrator, an auditor, where required, a custodian/prime broker, where required, and independent directors, where required. Documentation. Core documents include the offering memorandum or confidential information memorandum, the limited partnership agreement or articles of association, the subscription agreement, and the redemption notice. Entity incorporation and registration. The vehicle is incorporated or established with the Cayman Islands Registrar of Companies or Registrar of Limited Partnerships. An application for registration is then made to CIA under the Mutual Funds Act or the Private Funds Act, as applicable. Anti-money laundering compliance. The fund must appoint an AML compliance officer, a money laundering reporting officer, and a deputy MLRO, and implement procedures consistent with the Cayman Islands anti-money laundering regulations. Economic substance considerations. The fund is classified as an investment fund under the International Tax Cooperation Economic Substance Act, as revised, and is therefore not within the scope of such act, and it must file an annual economic substance notification with the Cayman Tax Information Authority to that effect annually. How Cayman Islands funds compare to other fund jurisdictions. Fund managers evaluating domicile options typically compare Cayman with Luxembourg, Ireland, and the British Virgin Islands. Each jurisdiction serves a different investor profile and distribution strategy. 1. Cayman versus Luxembourg. Luxembourg offers EU-regulated fund structures, UCIT, and RAFs, with passporting rights across the European Economic Area. Cayman remains preferred for Asia or US-facing hedge fund strategies, where EU distribution is not required, given its simpler regulatory framework, lower operating costs, and faster time to market. 2. Cayman versus Ireland. Ireland competes primarily in the UCIT, ETS, retail, and QIAF institutional space for managers requiring an EU-domiciled product. Cayman is more commonly used for non-EU hedge fund strategies, particularly those with US-Asian managers, and a global, non-EU-centric investor base. 3. Cayman versus BVI. The BVI is a cost-effective alternative for smaller or start-up managers and is frequently used for closed-ended private equity and venture capital structures with a single investment. Cayman offers deeper institutional acceptance, a broader range of regulated fund categories, and a more developed body of investment fund case law. In practice, many global fund platforms maintain both a Cayman master or feeder vehicle for US and non-EU investors, alongside an EU-regulated fund for EEA distribution, reflecting the complementary role that Cayman plays in cross-border fund architecture. Role of CIA in regulating Cayman Islands mutual funds. CIMA is the sole financial services regulator and is responsible for the registration, licensing, and ongoing supervision of investment funds. Under the Mutual Funds Act, funds fall into one of three regulatory categories. 1. Registered mutual funds, the most common category. The fund files prescribed particulars with CIMA and must have its equity interests listed on a recognized stock exchange or minimum initial investments of $100,000 per investor. 2. Administered mutual funds. Funds whose principal office is in the Cayman Islands and which have a licensed fund administrator providing their principal office. 3. Licensed mutual funds. Funds that hold a full license from CIMA, subject to more detailed supervisory conditions. CIMA's supervisory approach includes annual filings, audited financial statement requirements, the power to request information, and, where necessary, enforcement action, including the ability to apply to the Grand Court for the winding up of a fund. Since 2020, private funds, closed-ended vehicles, have been brought within a parallel registration regime under the Private Funds Act, closing a previous regulatory gap. Funds must also comply with international standards on tax transparency, including the Common Reporting Standard, CRS, and FATCA reporting obligations, economic substance requirements, and beneficial ownership reporting under the Beneficial Ownership Transparency Act. Typical U.S. manager use cases and common master feeder structures. U.S.-based hedge fund managers are the single largest group of Cayman fund sponsors. Most U.S. managers use a Cayman vehicle as part of a master feeder arrangement designed to accommodate the different tax and regulatory profiles of U.S. taxable investors, U.S. tax-exempt investors, and non-U.S. investors within a single investment program. In the standard master feeder model, a Cayman-domiciled master fund sits at the top of the structure and conducts all trading activity. Two or more feeder funds invest substantially all of their assets into the master fund. Onshore, U.S. feeder. Typically a Delaware Limited Partnership or LLC, designed for U.S. taxable investors who require flow-through tax treatment and a U.S. source schedule, K-1. Offshore, Cayman feeder. A Cayman-exempted company or exempted limited partnership that accepts subscriptions from U.S. tax-exempt investors, pension plans, endowments, foundations, and non-U.S. investors, both of whom benefit from investing through an offshore blocker that shields them from effectively connected income and unrelated business taxable income, UBTI. The master fund is almost invariably a Cayman vehicle, usually an exempted limited partnership for strategies that benefit from partnership tax treatment at the master level, or an exempted company where a corporate form is preferred. This structure allows the manager to operate a single portfolio while segregating investors by tax and regulatory need. Other common U.S. manager use cases include standalone Cayman funds marketed exclusively to non-U.S. investors, mini-master structures, where a single Cayman fund accepts both U.S. and non-U.S. investors directly, relying on check-the-box elections for U.S. tax purposes, and parallel fund arrangements where side-by-side Cayman and Delaware vehicles invest on substantially the same terms without a master fund. How Harneys can help. We are one of the world's leading offshore law firms and a market leader in Cayman Islands investment fund formation and structuring. Our dedicated funds team advises managers, sponsors, institutional investors, and service providers across the full fund lifecycle, from initial structuring and regulatory registration through to ongoing operational matters and restructurings. Our Cayman funds practice routinely advises on formation of hedge funds, private equity funds, and hybrid vehicles, including master feeder, parallel, and standalone structures. CIMA registration and licensing under the Mutual Funds Act and the Private Funds Act. Structuring of segregated portfolio companies, exempted limited partnerships, and unit trusts. Drafting and negotiation of offering memoranda, partnership agreements, subscription documents, redemption notices, and side letters. Ongoing regulatory compliance, including AML, economic substance, CRS, and FATCA reporting obligations. Fund restructurings, migrations, mergers, and wind-downs. With offices across the major offshore jurisdictions, we offer a seamless, multi-jurisdictional service for managers structuring across Cayman, BVI, Luxembourg, and other key fund domiciles. To discuss how we can support your next fund launch or restructuring, please contact our Cayman Islands Funds team.